Hi friends, in this session we are going to discuss about accounting concepts and conventions. So, we will start with accounting concepts. So there are many kinds of accounting concepts like separate business entity concept. It states that a transaction associated with a business must be recorded separately from those of its owners or other businesses. For example, when a person invests rupees 10 lakhs into a business, it will be treated that the business has borrowed that money from the owner and it will be shown as a liability in the books of accounts of a business. Now, money measurement concept. In accounting, only those business transactions are recorded which can be expressed in terms of money. In other words, a fact or transaction or happening which cannot be expressed in terms of money is not recorded in accounting books. For example, general health condition of the managing director of the company, working conditions in which a worker has to work, sales policy pursued by the enterprise, quality of product introduced by the enterprise. Though these things exert a great influence on the productivity and profitability of the enterprise, but these are not recorded in the books of account, as because these things cannot be expressed in terms of money. Dual aspect concept. The dual aspect concept states that every business transactions have two aspects and requires recordation into two different accounts. This concept is the basis of double entry accounting, which requires is by all accounting framework in order to produce reliable financial statements. For example, if a firm sells goods of rupees 5,000, this transaction involves two aspects. One aspect is the delivery of goods, another aspect is immediate receipt of cash in case of cash sales. So, we will be recording in this transaction in two accounts, that is cash account and the goods account. Accounting period concept. This concept states that the life of the business should be divided into appropriate segments for studying the financial results shown by the enterprise after each segment. Going concern concept. Accounting assumes that the business entity will continue to operate for a long time in the future unless there is a good evidence to the contrary. Because of this assumption, the accountant, while valuing the assets, does not take into account forced sale value of them. In fact, the assumption that the business is not expected to be liquidated in the foreseeable future establishes the basis for many of the valuations and allocations in accounting. For example, the accountant charges depreciation on fixed asset. It is this assumption which underlines the decision of investors to commit capital to enterprise. Only on the basis of these assumptions accounting process can remain stable and achieve the objective of correctly reporting and recording on the capital investment, the efficiency of management and the position of the enterprise as a going concern. Cost concept. The cost concept of accounting states that all the acquisition of items such as assets or things needed for expending should be recorded in financial statement at the value at which it is purchased, regardless of its market value. For example, if a business buys a plant for rupees 5 lakhs, the asset would be recorded in the books at rupees 5 lakhs, even if its market value at that time happens to be rupees 6 lakhs. Matching concept. Matching concept of accounting states that a year's income and expenses in an accounting period should be recognized and recorded as and when they occur or arise, and not when they are received or settled irrespectively. For example, if a commission is paid in January 2002 for services enjoyed in November 2001, that commission should be taken as the cost for services rendered in November 2001. Accrual concept. It states that business transactions are recorded when they occur and not when the related payments are received or made. This concept is called accrual basis of accounting. Realization concept. According to this concept, revenue is only recognized when it is realized. Now, revenue is the cash inflow for a business arising from the sale of goods or services, and you assume that revenue is realized only when it is legally arises to be received. So, in simpler terms, the profit earned when will be recorded when it is actually earned. Now, coming to the conventions of accounting. Conventions of materiality. The materiality concept states that items of small significance need not be given strictly theoretical correct statement. In fact, there are many events in business which are insignificant in nature. The cost of recording and showing in financial statements such events may not be well justified by the utility derived from the information. Conventions of consistency. The conventions of consistency requires that once a firm decided on certain accounting policies and method and has used this for some time, it should continue to use the same method or procedure for all subsequent similar events and transactions unless it has a sound reason to do otherwise. In other words, accounting practices should remain unchanged from one period to another. For example, if a firm decides that it will make a depreciation on fixed assets according to straight line method, this method should be followed year after year. Amongelessly, if stock is valued at cost or market price, whichever is less, this principle should be applied in each subsequent year. Convention of conservatism. The concept requires that the accountant must follow the policy of playing safe while recording business transactions and events. That is why the accountant follow the rule anticipate no profit but provide for all possible losses while recording the business events. This rule means that an accountant should record lowest possible value for all assets and revenue and the highest possible values for liabilities and expenses. Friends, in our next session, we are going to discuss about assets and different kinds of assets. Till then, you follow our page on Instagram and subscribe to our YouTube channel. I have given the link below. Thank you.